This video is created by Jagrat Creation. It is on profit prior to incorporation, hence useful to the students who are reading for CA Intermediate, ICWAI Executive, CS Executive, BCom or say CA-IPCC. The video is on profit prior to incorporation. I want to solve one sum here before you, that is on profit prior to incorporation. Observe the sum on the screen. Ram Udyog Limited was incorporated on August 1, 2015. It had acquired a running business of Ramayana Company with effect from 1st of April 2015. During 15-16 total sales were rupees 36 lakhs. Sales per month in the first half year were half of what they were in the later half year. So in first 6 months, monthly sale was one half than the monthly sales of last half of the year. Net profit of the company, rupees 2 lakhs, was worked out after charging following expenses: depreciation, director fees, preliminary expenses, office expense and audit fees, selling expenses, interest paid to vendor, interest to vendor up to 31st of August 2015, 5,000. Please ascertain pre-incorporation and post-incorporation profit for the year ended on 31st of March 2016. Normally, in all sums or in majority of the sums, you are given the details of gross profit, expenses are deducted therefrom for the whole year, and net profit is given to you. So generally the format of profit and loss account is given to you, and you are required to find out pre-incorporation profit or loss or post-incorporation profit or loss. In this sum, you are given expenses and you are given net profit, and the net profit is given to you after debiting following expenses, after charging following expenses. So you are required to add all these expenses to the net profit and find the gross profit. That gross profit will be distributed in the ratio of sales between pre and post incorporation period. This is the one of the important point of this sum. For the purpose of solving the sum, all these expenses given to us are required to be bifurcated into pre-incorporation and post-incorporation period. Some of the expenses are time relevant, so we are required to find out the time ratio between pre and post-incorporation. We are also required to find out the sales ratio, because certain expenses are based on sales, they can be distributed on the basis of sales. So sales ratio between pre and post incorporation is also required to be worked out. So for the purpose of solving the sum, first of all, I will work out time ratio. For time ratio, I will prepare a working note over here. First of all, the date of purchase of business, 1st of April 2015. Date of incorporation, 1st of August 2015. During the year 2015-16, so accounting period ends on 31st of March 2016. Pre-incorporation period is from 1/4 to 1/8, so 4 months. Post-incorporation period from 1st of August to 31st of March, so it works out to 8 months. Time ratio between pre and post, 4:8. That is 1:2. So this is how time ratio is worked out. I will write down time ratio in a corner because I am going to use this time ratio for the purpose of solving the sum. Now I want to work out next sales ratio. First of all, I will draw a timeline for the number of months before incorporation, number of months after incorporation. As you know, that pre-incorporation months are 4, post-incorporation's months are 8. Which months? April, May, June, July. Date of incorporation is the 1st of August. So period from 1st of August onwards is a post-incorporation period. Number of months in an accounting period is up to March. The important statement given to you for finding out the sales ratio, that sales per month in the first half of the year were half of what they were in the later half. So in first 6 months, suppose the sales is 1 rupee, then the sales will be rupees 2 in the last 6 months. So on the basis of that, I write down the sales for first 6 months 1, 1, 1, 1, 1. Then I will write down 2, 2. Now if I make a total for pre-incorporation period, it is 4. Same. 6 2s are 12 plus 2, 14. 4:14 is the sales ratio. That is 2:7. So I write down the sales ratio in a corner because I want to use this while solving the sum. After this, I want to prepare a statement for bifurcating or for the purpose of finding out the profit for a pre-incorporation and post-incorporation period. So this is the total amount of expenses, and the gross profit given to me will be recorded in total amount. Basis of allocation, time relevant expenses will be distributed in the proportion of time. Sales relevant expenses will be distributed in the sales ratio. If some specific expenses are there, just like director fees, it will go to the post-incorporation period, or any other expense for which the specific information is given to us. It will be bifurcated in light of the specific information given to us. First of all, net profit is given to you and these expenses are given to you. I am not given gross profit as I told to you. So first of all, I would prefer to find out the gross profit by adding all these expenses to the net profit given to me. For that, I prepare a working note. Net profit plus all expenses, 2 lakhs plus 1,08,000 plus 50,000 plus 12,000 plus 93 plus 72 plus 5,000. So total of all these expenses will be added to 2 lakhs. So my gross profit works out to be 5,40,000. This gross profit will be distributed in the ratio of sales. So total amount 5,40,000. Sales ratio 2:7. So 5,40,000 into 2 by 9. 1,20,000 pre-incorporation. 5,40,000 into 7 by 9. 4,20,000. This is the income, gross profit income for a post-incorporation period. Depreciation distributed on the basis of time. Time ratio is 1:2. So 1,08,000 into 1/3 pre-incorporation, 36,000. Post-incorporation 1,08,000 into 2 by 3, 72,000. Then comes next director fees, post-incorporation expense. Preliminary expenses, return of IC. So it's post-incorporation. Office expenses and audit fee 93,000, that is distributed in the ratio of time, because audit fees are considered at par with office expenses. So time ratio is 1:2. So 93,000 into 1/3 and 93,000 into 2/3. Post incorporation 62,000. Then comes sales expenses, sales ratio. That's given to you 2/7. So here 72,000. 2:7, so 2/9, 16,000. Pre-incorporation. If I want to work out post-incorporation, 72,000 into 7/9. So 56,000. Then comes, after selling expenses, interest paid to vendor up to 31st of August. Date of incorporation is 1st of August. Interest is paid up to 31st of August. So interest is paid for 4 months of pre-incorporation and 1 month of post-incorporation. Interest is an expense based on time, so it will be distributed on the basis of this information 4 months. So it is paid up to 31st of August, so all the subsequent months are irrelevant. So 4:1 is the ratio in which 5,000 is to be distributed, 5,000 into 4/5. So 4,000 pre-incorporation and 1,000 post-incorporation. After distributing this, from this income expenses will be deducted. So total of expenses that will be deducted. 5,40,000, 3,40,000. Difference is 2 lakhs. That is already given to you. Now here 1,20,000 minus 87,000 is the pre-incorporation profit, and 4,20,000 minus 2,53,000 is post-incorporation profit. So 33,000 is the pre-incorporation profit. 1,67,000 is a post-incorporation profit. This is a capital profit. Pre-incorporation profit is transferred to capital reserve. Post-incorporation profit, its character is that of a revenue nature, which is available for distribution of dividend like that, and that is 1,67,000. This is how this sum is solved here before you. I have tried to explain you this sum. I feel that you have followed all these things. Thanks to all of you.